Imagine an entire country's financial system imploding in just 1 week. That sounds like something out of a disaster movie, right? No, the 2008 Icelandic banking collapse might just be one of the most shocking financial stories ever. But one thing always confused me: the sheer scale of the meltdown. I mean, how did a tiny island nation of fishermen suddenly become a global financial player and then go spectacularly bankrupt? So let's tackle that question. In this video, we're going to explore just how Iceland's banks took over the world and then brought the whole country down with them. So buckle in, it's going to be an interesting one. Before we dive into the details, there are a couple of basic facts we need to understand about Iceland's economy at the time. Before the 2000s, Iceland was mostly known for fishing, volcanic landscapes, and beer. Its economy was stable but small. Then, in the early 2000s, the government privatized and deregulated its banking sector. This unleashed an unprecedented wave of ambition. Icelandic banks started borrowing money from international markets at a furious pace and expanding aggressively overseas. The key thing to remember is that this wasn't a gradual growth, it was an explosion. So, the bigger these banks got, the more of a high-wire act the entire country was performing. Okay, let's get started with the sheer absurdity of the numbers. At the peak of its financial madness, just before the 2008 crash, Iceland had transformed from a quiet fishing nation into a gargantuan financial hub, at least on paper. The country's bank assets were mind-bogglingly large compared to its tiny gross domestic product, or GDP. Think about it this way: a country's GDP is the total value of everything it produces in a year. For most healthy economies, the banking sector is a fraction of that size. But in Iceland, the total assets held by its three main banks swelled to over 10 times the nation's entire GDP. That's like a single family having a credit card debt 10 times larger than their annual salary. The country's total economic output was around $14 billion, but its banks were juggling assets worth over $140 billion. This wasn't just ambitious, it was a ticking time bomb. The entire nation's economy was propped up by a banking system that had grown far too big to fail, but also, as it would turn out, far too big to save. When the 2008 global financial crisis hit, that time bomb detonated with spectacular force. The catastrophe centered around Iceland's three largest banks: Kaupthing, Landsbanki, and Glitnir. These weren't just local Icelandic banks anymore. They were major international players. They had expanded aggressively across Europe, buying up businesses and attracting foreign depositors with high interest rates. Their combined assets, as we mentioned, were over 10 times the size of Iceland's economy. When the global credit markets froze, these banks could no longer borrow the short-term money they needed to fund their long-term debts. They were suddenly insolvent. The Icelandic government was faced with an impossible choice. In the US and the UK, governments bailed out their too-big-to-fail banks. But Iceland simply couldn't. The country's central bank had reserves of only a few $1 billion. Trying to bail out a banking system with liabilities exceeding $140 billion would be like trying to put out a forest fire with a water pistol. The government had no choice but to let them collapse. Within the space of a single week in October 2008, all three banks were taken into state receivership. The whole house of cards came crashing down. The collapse of the banks triggered an immediate and brutal implosion of the national currency, the Icelandic krona. As international confidence evaporated overnight, investors fled, dumping the krona for anything they could get. The currency went into freefall. In a matter of days, the krona lost over 50% of its value against the euro. This meant that the purchasing power of every single person in Iceland was effectively cut in half. Imagine waking up one morning to find that the money in your bank account could only buy half of what it could yesterday. The price of imported goods, which Iceland heavily relies on for everything from food to fuel to cars, skyrocketed. A jar of jam that cost the equivalent of $3 one week suddenly cost $6 the next. Inflation soared to nearly 19%. For ordinary Icelanders, it was a waking nightmare. Their savings were decimated. Their mortgages, many of which were indexed to foreign currencies, doubled overnight, and the dream of prosperity built on financial engineering had vanished, replaced by the grim reality of national bankruptcy. The disaster wasn't just contained within Iceland's borders. It sparked a major international incident. One of the ways Icelandic banks had grown so fast was by offering high-interest online savings accounts across Europe. The most famous of these was iSave, an online arm of Landsbanki Bank that became incredibly popular. In the United Kingdom and the Netherlands, it offered interest rates that traditional British banks couldn't match. and hundreds of thousands of ordinary people, as well as charities and local councils, poured their life savings into it. When Landsbanki collapsed, over $4 billion, belonging to more than 300,000 British savers, were frozen. The Icelandic government, already bankrupt, announced it couldn't guarantee these foreign deposits. This caused outrage in the UK. The British government stepped in to compensate its own citizens, but then used anti-terrorism legislation to freeze Icelandic assets in the UK, an act that Icelanders saw as a hostile and deeply humiliating move. A diplomatic firestorm erupted between the two NATO allies, a dispute that would drag on for years and became known as the Icesave dispute. One Redditor on the R-Europe subreddit actually dug up old news articles from the time, creating a timeline that showed just how tense things got, with Iceland's Prime Minister calling the UK's actions a hostile act. Hats off to that Redditor for compiling the receipts on that diplomatic fallout. Yet, from the ashes of this complete economic demolition, Iceland staged what many now call a recovery miracle. The path back was painful and took several years. But the country's approach was radically different from what we saw in the United States or the UK. Instead of just bailing out the system and letting executives walk away, Iceland let the banks fail. It imposed strict capital controls to stop money from flooding out of the country and stabilize the krona. The government focused on protecting its citizens, forgiving a portion of mortgage debt for struggling homeowners. But most notably, Iceland did something almost no other country dared to do. It held the bankers accountable. Special prosecutors were appointed, and dozens of high-level banking executives and financiers were investigated, charged, and ultimately convicted for their roles in the crash. Many were sentenced to prison. A user on a finance forum actually managed to compile a list of all the major bankers who were jailed, and it's a stark contrast to the lack of prosecutions in other countries. Now, this Redditor really put in the work, highlighting that by 2015, 26 bankers had been sentenced to a combined 74 years in prison. This commitment to justice, combined with a painful economic restructuring and a rebound in its traditional industries like tourism and fishing, allowed Iceland to recover far faster than anyone predicted, eventually repaying its loans to the IMF ahead of schedule.